All right, thank you. I'd like to call the meeting to order here. Happy New Year, everyone. Welcome. We've been apart for a while. We have a very busy day, very busy meeting, packed agenda ahead of us. I'd like to kick it off with point number 2 on the agenda to hear, consider, and approve the minutes of the December 2nd, 2020 JRIB meeting. Why don't you take a moment to look through it if you haven't already? And I'd like if someone could please make a motion on the minutes when you've done looking through it.
Hello, this is Brian from Vanguard.
Hi, Brian. Thanks for joining us.
I've been, I just dialed in with my phone, but I followed the WebEx instructions. I'm just in the meeting room.
Okay. You know what? I'm going to send you, I'll send you what I have. Give me just a moment.
Yeah, I just used what Cheryl Lynch had sent.
Yeah, we're definitely going to need you in the on the WebEx.
Okay. So should I just wait and look for an email from you?
Yep.
Okay.
In the meanwhile, if someone wants to make a motion on the minutes, please.
Tom McCarthy, motion to accept.
Okay. Tom McCarthy's made a motion. Do we have a second?
Yeah, it's Jack. I'll second it.
Jack Mahoney to second. Okay. Any comments or discussion on the minutes? No? Okay. All in favor of approving the minutes, please say aye.
Aye.
Aye. Aye.
Are there any opposed or abstain? All right. Minutes pass. Thank you. Next up is our actuary presentation for the pension funds. And as you know, guys, our purview is both the pension and OPEB. The OPEB numbers will be available next month. You will see this on the agenda for next month, the actuary review for OPEB. This month, however, I've invited Stefan from Hooker and Holcomb to come and give us a presentation on the pension side. With that, before we begin, if I may ask everyone, while Stefan speaks, if you might please mute your phones or mute your WebEx so that we can all hear it clearly. That would be great. Stefan, please take it away. Stefan, I think you're muted, Stefan.
I always forget. Sorry, but I always forget. I unmute my phone, but I got to put it on the screen as well. Sorry about that. Does everybody have the presentation I had sent out the other day? If not, I can share my screen and we can pull it up. That works.
That's a good thing.
Yeah. Yeah. Please share the screen.
Let's see, is that coming? Let me see if that'll do it. All right. Does everybody see that?
Yep. Yeah.
Yep.
Okay. All right. Okay. So this is our annual review when we go and meet in front of you guys. Usually it's face to face, which is a lot better than doing it on video because I can't really read the room. I don't know how they're comprehending things or whatnot. So if I go too fast, slow me down. I understand there's a few of you guys that probably haven't gone through this presentation before, so there might be some questions you have about it. So feel free to ask. I don't like to just have to ramble on for however long it takes. It's always better, kind of a little collaboration, a little banter between us. So with that, let me go too fast. So the overview of it, we'll talk about the valuation, what its purpose is, why we do the annual valuation, why we do that. Touch base a little bit on the gains and losses that occur each year. Quickly talk about the data summary so you can get a snapshot of how the population will change from 19 to 20. Most of our time will be spent talking on the actual results of the valuation. And those results will show a couple different assumption sets where we'll ultimately decide what to fund for next year. The assumption, I'll talk about the key assumption that we'll probably talk about today. And there's some projections based on those different scenarios. So we'll look at that and then questions and answers. But I put questions and answers at the end, but you can always ask them as we go along. It'd probably be better that way you don't forget. All right. So as we start, purpose of the valuation. The key is that, there's a true cost of the pension plan. And it's based on what's been promised by the town to pay their participants, their employees that work for the town, whether different unions, whether it's police and fire, or the different unions that are covered under the town pension plan. And the key, and the true cost to the town is they have to pay for those benefits and any expenses incurred to provide those benefits, whether it be the actuary, the auditor, attorney fees. Investment fees can come out of the asset statement, so those aren't really incurred there. And those are kind of offset by employee contributions. And the biggest one you kind of like to see is the investment return. The better the investment return, the less the town has to pick up. So what happens when you do the evaluation? You utilize a cost method to kind of determine what that cost is going to be each year. And we determine that so we can come up with a systematic approach of how the town's going to contribute to that fund to pay for those benefits when they come due. What we do, we develop what we call an ADEC, an actual determined employer contribution. And that's what you fund each year to cover these benefits when they come due. And there's two parts that make up that ADEC. One is the normal cost. The normal cost, what that is the benefits that are earned for each year. So that's kind of based on what that salary is and based on 1 year of service and how much of a benefit they're going to earn. It could be $1,000 a year that they're going to earn for this year. So you kind of budget for that, and that's the annual cost. When towns get into trouble is when they don't make those annual costs, and that's what happened with the state and a lot of other town plans. When someone's not 100% funded, it's usually because they did not fully fund each year's normal cost. The other key piece of that employer contribution is the unfunded liability. What that is, that's kind of what we'll call the past service cost. That's for that shortfall that haven't been covered each year, whether it be based on not putting the full normal cost in or gains or losses that the plan's incurred over time. That we unfund that. We amortize that kind of like the mortgage, and that's currently being done over 21 years. Okay. Next two slides are based on the assets and kind of how they performed the past year. We started, this is the town side, so we'll talk about this one. They started on a market value basis, that's $205 million. They dropped down to 200. What they had, you can see, they only put in just under $6 million contributions. They paid out over $12 million in benefits and had a kind of a dismal year that we saw. They only earned 1.2 million. And that's for on a market basis, only 0.5%, a little over 0.5%. And what we do, and this other column is the actual value of assets, and that's how we determine the contribution. We fund on this, and this is a smooth value. Again, on this basis, assets earn 5%. You can see there's a difference of $10 million, and what that is, that's really unrecognized gains or losses. In this case, unrecognized losses that haven't flown through. So those get amortized over 5 years. You see the similar thing on the police and fire side. I won't go into detail on that, but it's basically the same. They earned a little better on the market basis at 1%, but still the 5% on the actuarial basis. So the gains and losses. These two charts on the top for the town and the police and the fire, these kind of show you how we smooth assets for actual value, which is what we use to determine the contribution. Again, you see we smoothed in 5 years worth. You have some sizable losses back in 15 and 16, and again, 19 and 20 were over $10 million for those plans. That's a big chunk. So we smooth those. We take 20% of that. We amortize, or we kind of recognize 20% of that each year. So right now, based on all those losses, we still have $10 million 10.3 million on the town side and 8.7 million on the police and fire side. This 10 million, 8.7 million is the difference up here, the 184 and the 192. That's the difference that we haven't recognized yet. So what tends to happen? This middle bullet kind of talks about that. So between the two plans, we have over 19 million of assets of losses that haven't been fully recognized. And what that means is over time, the contribution will be expected to go up to about another 1.6 million. That is because, like I said, the assets are now currently $10 million higher than market. But once actual value equals the market value, what happens that when it shrinks, the unfunded grows. So you still have to amortize that unfunded. So you got to pay that unfunded. So that's kind of what's going to happen with the contribution. Again, ideally, we hope it gets offset by some gains. As the gains increase, that'll lower unfunded. So it'll be less of a burden on the contribution side.
Stefan, can I interrupt and ask a question? This is as of the end of June 30th, right?
Correct. So if we kind of looked at right now, I'll say 12/31, we know that the plan's done a lot better. I'm sure Brian's going to talk a little bit about that and give you an update on the fourth quarter or the second quarter of the fiscal year, however you look at that. I'm sure they're much improved. So ideally, what we'd like to see is that continues. So when we look at this again on June 30th, 21, it's a lot better of a picture, right? It's not as gloom and doom. Obviously, we thought this was going to be a 20 million loss when we first were talking about this back in April-ish. But from April and May, that's obviously picked up a little, and so it was only a 10 million loss roughly in each plan. So we thought it was going to be a little bit worse, but obviously it's still pretty bad at the end of the day.
Yep.
So yeah, does that answer the question, Carolyn?
Yeah, thank you.
Okay. As I said, the first two bullets, 0.5% and 1%, excuse me, they earned, and that's much less than the 7% we expect. On an actuarial basis, which is again how we fund, that rate of return was only 5%. So there's still, 5 million. They still lost 5.4 million on an actuarial basis. Not quite as bad as the 13 and 11 on a market value basis, but still bad enough where it's going to drive the contribution up a little bit. I talked the third bullet. So the fourth bullet. So as well as we have asset losses, but we also have liabilities, gains, and losses. This year, the town plan had some gains. Those gains were about 1.2 million. Again, asset losses were much greater than that, which is driving the contribution up. But those gains happen to be due to mortality experience, which means more people had passed away than we expected. And every time someone passes away, you get a gain. Whenever someone lives, you get a loss. And we also had some salary gains, and that was primarily due to nobody getting pay raises this past year for this valuation cycle. They froze a lot of the pay. They kept it the same pay as the 19 year. So we got some gains on that. And there's some minor retirement losses due to service buybacks and whatnot. And then a few people had bigger COLAs than we had expected. And that's on the town side. Police and fire plan, same thing. They had gains of, and this were a little bigger. They had 4.1 million. Again, those were mostly due to salary. They had some minor ones due to mortality and retirement. All right. Is that good so far? No questions?
That's
All
good.
right.
So,
It's good.
thank you.
I'm wondering, can people put their phones on or their screens on mute?
Okay. Someone will, hopefully. But all right. This is just a kind of a graphical representation of how the assets performed over the last half a dozen years or so. Purple line is on a market value basis. And what you can kind of see this has bigger swings, 14 to 15, over 15% in 14, then down probably to 3% in 15, 16, back up to 10% in 17, 18 was good. 19 and 20, again, 5%, and like we said, about 1%. And the reason we have this red line is why we smooth assets, right? We want to kind of lessen the volatility from year to year. It's very hard for towns or anyone really to budget when assets go up and down like that, right? It's very painful to have to do that. So by smoothing the assets, you get a much more predictable contribution. It's easier to manage the swings in the market value of assets that change over year. Again, this looks like it's been around 5.5% over the last 4 or 5 years. Again, that is below our 7% assumption. So assets haven't quite performed as well as we would like them to. Okay.
Stefan, before you leave that graph, so you've explained how losses, well, your actual curve's obviously flatter than market, and
Correct.
that cuts in both directions. And I understand you've
Correct.
you know, when I looked at this before, I was actually kind of scratching my head trying to understand the math involved. But you've explained how the losses are mitigated because they're recognized over a 5-year period.
Yep.
But
And
if the market outperforms, how is that smooth on the other end? I mean,
again, you recognize gains over 5 years as well. So if we look at the flip side of this, I went back a slide. Instead of all these losses, if these were big gains, and this 10 million was a positive number, right here, that means your actual value would be $10 million lower than market, right? Again, so that's not, ideal. If they actually perform the same as market, you would have a true representation of your unfunded liability. But again, like I said, it's very hard. Gains are great, so towns, you kind of bank some of that gain in the future years, same way as losses. Again, like you said, it cuts both ways. Right now, it's been helping you because you've had substantial losses over the last 4 or 5 years. The losses that far outweigh the gains that you've had those couple of years.
Okay.
So if all 5 years of gains, your contribution would be up a little bit higher because your assets would be artificially lower than on a market basis. Does that make sense?
yeah, I'm still trying to digest it, quite honestly. I'm following along as you go. So.
You want me to try to do it a little better than that, or you think you have a handle?
I mean, I just wanted to understand from my simple mind that the variance of the curve relative to the, and again, it just appears. I mean, the short answer is you're recognizing those deviations over a longer period of time.
Mm-hmm. Over 5 years, yep.
Okay.
And really what's happening is these big 15 and 16 and 20, these huge losses on the market basis is kind of dragging the actual value down, or I guess maybe it's hard, so you're not fully recognizing them. So it's helping you to keep it helps your contribution not be as severe as it would be. Instead of a $10 million contribution, maybe it's only $9 million. So it's helping you to spread that over a few years, right? As opposed to if we didn't smooth assets at all, you'd have to recognize all that huge loss of $10 million in 1 year, and so that'd be $10 million you amortize over 20 years, which is probably $500,000 or plus, roughly. That would impact your contribution.
Okay.
And that's really the whole point of that, because, like I said, towns, it's very difficult to budget a year to year when things go up. Say you have great gains, hey, the town's going to be happy, right? Your contribution is going to go down $500,000, right? That's great, all fine and dandy, and they take the money and put it somewhere else. But then that flip year, that year losses go the other way, it's much harder for them to get that money back, right? That's already been allocated. It's harder, because of other entities within the town probably want that money, so it's harder. It's much more difficult for them to allocate the money to the pension plan.
I know that.
By smoothing it, it helps mitigate. It's not so much one way up or down, but it's kind of a little bit bumpy. So it's much easier, I think, for towns to manage that.
Yep.
Okay.
No question there.
I'm sure it's not perfectly clear. Probably still a little clear as mud, but I hope it's a little better. A little less murky. All right. So moving on. We don't really have to spend a ton of time here. This is just kind of a snapshot of the data of where we are at. And if I had the town and, side by side from 19 to 20, you'd see the town kind of went down. But again, we have on the police and fire, 416 bodies, and the town side, just over 1,000. On the town side, one thing you'll notice, the actives is going to continue to go down, and that retiree category will go up. Eventually this 436 will drop down to 0 because this is a closed plan, so there's no new entrants going into the town. Police and fire are continuing to be open, so this 196 will probably stay right around that 200 level, most likely, depending on whatever they feel is the proper number of police and firefighters that they need to employ. So it's probably right around that 200, 190 to 205 mark. So and the retirees will go up over time. And you can see the average age is on the town side, that 55, they're getting older. Every year they're going to get a little older as more people retire. And it's going to eventually be, like I said, it'll get up to 65 or so wherever everybody goes out. And then till there are no more actives left. Payroll, 17 million on police fire, 25 in the town. As we saw in the assets, you're paying over 12 million, roughly over 12 million in benefits for both plans. All right. So quick snapshot of 19, as I said, 471. So you saw that went down. The total count kind of stayed the same, but again, they'll stay pretty stable. So you can see on the town side, the total payroll went down because there are a few less active now. And as I mentioned, that they did get salary gains because some people, their salaries stayed the same, so it didn't go up as much. Okay. So let's just ignore that 219. That should have been 2020 pension results. I missed changing that when I updated the slides. But anyway, we'll talk about contributions, what's going to happen. So contributions last year, when we ultimately settled, were just under 12 million. They've gone up slightly. If we don't change anything, make any changes whatsoever to the pension plan and kept all the assumptions the same, it went up slightly by about 250, just about 260, 270,000, right? And that's mostly due to asset losses that we talked about. I mentioned we amortize that unfunded liability. We set that base at 25 years and 16. So right now it's at 21 years. So after 21 years, that you should be fully funded, right? Because we would have paid off all that unfunded liability. I mentioned the third bullet, with that 19 million of unrecognized.
Stefan, can I speak to that? Can I ask a question on that second point there?
Yep.
And I believe I asked a question last year, and I believe you
Okay.
answered it, but I want to make sure I truly understand it. So we used to have a 15-year open. So we used to reevaluate the unfunded liability and mortgage finance that over 15 years.
Mhm.
And now we're doing a
But-
25-year close based on the 2016 valuation. Now in 2016, we were underfunded by, let's say, 25 million, and now we're underfunded by 52 million. Explain to me how that delta between 2016 and 2020 in the CAFRs gets recognized and how that gets financed.
Well, it continues to get financed as the amortization period shrinks each year. So your first point, I'm surprised that you said it was 15-year open. I would have thought it might have been maybe 20-year open or 25-year open. 15 seems like a short period of time. But regardless, just think about the one word you stated, open. What does that mean? It'll always be 15 years and it'll never get fully paid off, right? There's no end. It's like a bottomless hole, so to speak, right? You're never gonna get fully funded that way if you're amortizing over open period. So what was done in 16, we said, okay, we're going to reset this 25 years, and we want all our unfunded liabilities paid off over those 25 years. Now, what happens on a year-to-year basis, and we just saw this, assets, they did really poorly. So now the assets, we expected the assets to be 210 million. They're only 200. So that means you got 10 million more in unfunded liability. That adds, if you said was 25 million, then it went up to 35. So over those last 4 or 5 years, you probably had, and we saw that, I think the 14, 15, and 15, 16 probably had 10 million plus in losses as well, because we saw those rates of return were in the 0.5% or 2% range. So again, you probably had, double digit, 10 plus million losses there. So that, even though that's 30 million additional liability that you were still only amortizing, each year of. So that's kind of how it grows, right? And think about when you first do a mortgage on a house. If you do a 30-year mortgage, your balance really doesn't go down. It takes a few years before you really start eating away at that interest, because you're usually just paying off the interest every year. But as the period gets shorter, you start to pay more and more of the principal, right? So when you get to like 10 years, you're going to be seeing that it's going to go down much quicker.
Okay,
All right.
so now let's fast forward now we're 10 years in the future.
Yep.
And we still have a delta between our recognized assets and our unfunded liability.
Mhm.
At some point, do we refinance that? Do the payments just get bigger? How?
If nothing changed, the pay and that delta grew a little bit, then yes, your payments would go up. But I think we would probably, hopefully, do something to minimize that before that happened, right? Because we kind of monitor it every year, right? And there's two different things you can do. Like one of the things we can always do, and I might have mentioned it last year, you can do layered amortization, right? It may not make sense on the town side because, as we mentioned, that's a closed plan. So really, by the time all those actives are gone, you want that plan to be fully funded, right? You don't want to be having to pay an unfunded when no one's earning benefits anymore, right? You really want to be, whether that last person's earned his last benefit, you want that plan to be fully funded. So the assets are hopefully just doing their work, right? Because then you're going to start changing the asset mix at that point in time as well, because they're going to have a shorter duration that they're going to be paid out. Now on the police and fire plan, that you have some different options, right? You could always look at a layered amortization, and what that would do, say, not yet. I think going forward, when we get to 20 years, then we can kind of reset each change in the unfunded liability year. We can start amortizing that over 20 years. So we'll say we did it this year, right? We have 21 years. And then there's that we can measure the change based on gains and losses or assumption changes, right? Then we can take that piece from the original unfunded liability that we had last year and re-amortize that over a new 20-year period, just that smaller piece of unfunded liability, right? So that initial, we'll call it $50 million, that we've been amortizing will eventually be gone, and all you'll have left is the little pieces, the little slivers each year that accrue. And by doing that, that kind of equates, it's kind of what we'll call generation equity, right? That the people that incurred those gains and losses, they're the ones that are paying for that unfunded over their working lifetime, right? So that's something we can talk about, going forward as well.
Okay. Thank you, Stefan.
Yep. All right. What did I say? All right. Bullet 4. That says the current period of low inflation persists, and we'll probably have some salary and COLA gains in the near term, right? And it seems like from what I've heard that they expect inflation to be, remain kind of dormant for the next couple of years, I think, right? Until there's some stimulus. As I mentioned, the town normal costs will trend down, right? Because that's a closed plan. So as people start to retire, the normal cost is going to dip down, right? It grows, right, 1 year for salary, but it's probably going to shrink more than it grows each year because more and more people are retiring as they get closer to retirement age. And the last bullet kind of talks about the range that the contribution can be in. It can be in from 11.6 million to 13.13, and that we're going to probably talk about and what assumptions we ultimately decide on using. All right. And that's going to be coming up in the next few slides. Again, here's kind of a contribution summary on a couple of different ones. The far column to the right is our current fiscal year, right? 2021 fiscal year, and that's that 11.94. These are the different components. So if we kind of look at it, we have the normal cost, 2.79. The amortization unfunded liability, 3.23 million. You have interest on that. So 6.22 is the police and fire share. Likewise, 5.72 is the town share. Okay. The middle column is no changes whatsoever. We just use the same assumptions we used at late 19, and we kept them. And we can see it's 12.26, and that, like I said, predominantly is due to the change in assets by asset losses. And then the far cell, and I don't know where we're going to end up, but I just showed this one to be one. And this is at 6 3/4. That'll be the top of the range that you could ultimately be at, and that's 13.13 million. And that's just due to measuring liabilities at a lower discount rate. All right. The next 3 slides are kind of, we're going to see a whole bunch of numbers, but it's really the meat and potatoes of what we're going to discuss here, I think. It's going to be different assumption scenarios. And I think I'll just go to the combined group. This is the town, police and fire, and combined. I think you're going to want to see the numbers in aggregate, right? I think that makes the most sense. All right. So let me kind of go through them and stop me if it doesn't make sense. So like I said, the first line we call the baseline. That's with no assumption changes. And as we go down here, that's 12.26 million, 12.25. It's probably a little bit of a rounding error in the other slide, but it's 12.25 million. So our first, and I kind of did this systematically stepwise and how I think we would typically do the assumption changes. So the first one is, so last year we adopted the new public-based mortality table, and that's a mortality table that's geared strictly for the public sector employees. So what happens each year, the Society of Actuaries, when they came out with these new tables, there was 2 new tables. The old table we used to use, which was an RP table, and that came out in 14, and this PUB table, 210. What they do each year, they have what they call an improvement scale. That's the mortality improvement, MP. So each year it was 15, 16, 17, 18, 19. So the Society of Actuaries who developed the table said, we're going to have an improvement scale each and every year. So it makes no sense not to adopt that. And what's been happening since they did that first one in 15, they've been corrections. You know, the 15 one said people are living a lot longer than expected. So each year they found when they get new data from the Social Security Index, as well as I think they're using the CDC and a couple other sources as well, that they found that it wasn't quite right. People weren't living as long as they first expected. So each year there's been kind of a step correction downward, which lowers your liabilities. And that, as we can see, that happened here a little bit. So your contribution went down 250,000 roughly from going from the MP19 to the MP20. Okay. So that one I think would be a no-brainer. You know, everybody pretty much, because you already adopted these new tables, you would continue to use the new improvement scale. It just makes sense to do that. Ideally, it continues to go down, but there may be a year where it actually goes back up. Right now, we don't know how it's going to be. First indication was saying, you know, people always ask me, what's COVID going to do? How's that going to impact the mortality table? And that's what I've heard was that it's going to be 2 or 3 years at a minimum before they even see the impact, before they start to measure that. They'll see that, because there's a little bit of a lag. It's not like there's 20 tables using 19 data. It's using data from, I think, 3 years prior to that, maybe 16 or 17. I forget what the latest year is. So each year they get another sliver of data. But as I mentioned, they're not going to know the impact of COVID yet for a few years.
Stefan, so early last year, we voted on the new mortality table. The new step corrections, are those automatically implemented, or do we have to vote on those step implementations as well, or do you just calculate those?
I don't know that you necessarily have to vote on, because it's really kind of part of the latest tables. I would think you would just have a standard to use them, because to not use them, you know, the only reason not to use it is you want to save that step correction for a future year to lower the contribution in a future year. I haven't seen anybody that's not wanted to adopt them. We've been using whatever year when we do the valuation, that whatever that current table is, we use that. The only case I can see that not being the case is if you're going to do a mortality table study, you know, an experience study. But again, because mortality, you've already kind of made that assumption. We're going to use the latest tables that are out there. It doesn't make sense. It'd be hard to argue against using it, you know, because it'd be kind of counterproductive to, you know, to use the latest tables but not using the latest improvement scale.
Stefan, if I could hop in, it's Carolyn Trabucco following up on Chris Brand's question. So when I look at the presentation, the columns, and we've got the mortality table, and then the discount rate, and then the inflation estimate. I mean, these are effectively the three estimates that fall within kind of our broad purview of the pension board to weigh in on with your guidance and the insight of our OCIO, Brian from Vanguard. Yep. So I would suggest that you keep kind of running through this for us, and once we wrap up, we circle back around and we hone in on one of these.
Yeah. So the next column, I added inflation. Inflation. So what we look at when we say inflation, we look at what the Social Security, the report comes out every year, and it comes out in, I believe, around April-ish. So for the 2020 year, the inflation dropped from 2.6, according to that report, to 2.4. Your investment advisor will tell you they're probably using something different, maybe 2 to 2.25. That's what we've been finding for most of them. We use the Social Security one because that's kind of over a 60, 70 year period, which is more typical of how long a pension plan is going to last. Whereas an investment, Vanguard may be using a 20 or 30 year. Again, but that's entirely up to you to lower it. I mean, the impact of lowering it also means, then you really need to think about what discount rate you're using as well, because that's part of the underlying assumptions for the rate of return that you're going to get. But where we see this, why you see this going down, is because inflation, we use inflation as the baseline plus 1% for salary increases. So if inflation, we drop inflation, we're dropping what we expect salaries to increase by each year, right? And on the flip side, in good years when we're paying 4% in salary increases, we're going to see inflation go up and the cost will go up a little bit. So it's something to think about. I just wanted to make sure you guys were aware of it and how it impacts, whatever you guys decide. And I've seen some obviously adopted, others choose. They don't want that savings just yet. They want to save it when they're going to do something, a different kind of change. If they're going to drop their discount rate, they may use it in coordination with that, right? So say if you're going to drop your discount rate to 6.25 or 6.5 or 6 and 7, that's when they may decide to use the inflation drop as well. All right.
Yeah.
So we don't have to go through the next 3 columns right now if you don't want. We can continue on, but they just show the impact of dropping the discount rate by couple different scenarios. We can talk about them or not talk about them. We can move
Yeah.
on, but however you feel.
My preference is if that's all right with the rest of the board, is that we continue on and then we come back to this.
Yeah, because this is really, I think, what the main takeaway is going to be, where you guys think we should be in the pension side.
Right.
Okay. So the next few slides really, I just wanted to educate you, because I thought you said some people are new. Why is the investment return assumption important? Because that's really what we're probably focused on today, I think, because the big assumption was mortality. We chose to take that one last year. The other big one tends to be the investment return. Why is that important? And as I mentioned, that trust fund is built up, right? What you pay out is this bottom box, that benefits to retirees. What goes in? Employer contributions and investment income, right? So it's very key. It's a very key assumption. You want that to be kind of close to what the assets are actually going to earn, because when you overstate it, that means you're going to end up picking up bigger contributions down the road. So what is it? Why is it important? Like I said, looks like, as we see, and there was a study back in 2016, 68% of that pie was covered by investment return, right? There's 15% employer contribution, 16. The employee and employer are pretty close to being 50-50, right? Their portions are pretty equal, which you'd kind of like, right? And they'll either grow, they'll go from 15 maybe to 20, 30 if your assets don't perform quite as well. Ideally, you'd like this to perform, 80, 90%, right? But 68 is pretty high, but so it just kind of shows you the importance of that, of why investment return is so a big deal. Okay. So what we do, we consider a lot of things when we set that return, right? What inflation is going to be, right? Forecast of inflation and total returns for each asset class. We get the asset class information we would get that from Vanguard, and they would say, hey, this is what we expect based on your current asset allocation, those funds are going to earn long term. We look at current yields of maturity of fixed income, government securities, bonds, based on however you're invested. We look at the investment data, the plan performance. There may be other things that we can take a look at as well. But those are the key ones, tend to be inflation and where we expect the long-term rates of return based on asset class, where they're going to be. Okay. So those are kind of the key things. This slide here, each year we kind of survey all the CAFRs that we get a hold of when they're published. So this is as of 19, where the average rate was. Average rate was 6.74, right, for 191 plans. That dropped from 7 basis points from the prior year. So I would assume that when we look at all the 20 CAFRs, it probably continue to drop a little bit. I know a lot of our plans have gone down. There's still some that are up at 7, 1 or 2 that are over 7, but they're all in that 7 to 6.5 range. And some have been just trying to get down. I don't know what their target is. Everybody has a different target because they're all doing things differently, and they have a different population that they're trying to figure out. But again, no one's up at 8% anymore, right? Well, it looks like somebody is. There was somebody in 18, but they finally dropped theirs. So now in 19, nobody's that high. Probably have a couple that are still up in 7.75, but you are right in the bulk, right? You're in the middle, that 7 and 7.25%, right? That's the bulk of where everybody's at. The ones that are extremely low are probably plans that are probably all retirees. So there's no reason to be up at 7% because they're probably more in a fixed income type basis. So, that the sweet spot somewhere here, right? That's 6.5 to 7.25, or really 6 to 7. I think 6.5 to 7%. All right. One more. And the pension fund ratio, because that's always a key thing where you guys look at. You're right around that 80% level. That's 23%. Most plans tend to be in that 70 to 90%, right? Obviously we have a few that are over that 90%. But there's certainly our share of under, right? So the bulk of them, you have almost 50% between 70 and 90%. So, I would think you're in the 80% range. You're probably above over 50% of them. Okay. This slide is just kind of talking, where we're going to be with the investment return assumption. Where do you want to go? Where do you have a target? Obviously you guys have a new investment advisor, so there may be different ways. Your investments are a little different now, but where they lie. So that's something to think about. So what's the impact, right? Short term, raises you the cost. That's going to be the biggest thing for the town to handle, right? Because it's going to drive the liabilities. It'll lower your funding ratios a little bit, depending on how low you change that rate. And like I said, it will higher liabilities mean bigger contributions. Long term, what does that do? Most likely by having more conservative, you're more likely to hit your target, so you won't have those swings of the gains and losses that you do. So those losses won't accumulate as quickly as they have. Right now we're at what, 20 million, almost 20 million, 19 million in losses. We'd expect that to be lower. More stability in the contribution, that decreased pressure on future taxpayers, right? Because now you're paying for it now, realistically, what you should be earning. And one of the key things is credit positive, right? That the rating agency look at that. That's one of the key components that they look at, one of the metrics. All right, I think that's all of them. Oh, projections. Okay. What did I do? I did this at the middle one. This would be based on the new projection scale, the new MP20 mortality, and 2.4 inflation. So that drops it down to 11.61 for this year. And you can see your contribution is going to be in that 12 million range. You see it kind of ticks up a little bit for a few years. And that's really because mostly due to the asset losses, right? That's as you recognize those asset losses. As I mentioned, it might go up by about 1.6 million. So it's going up a little bit, not quite, a little over 1.2 million. And then it starts to drop back down because now you've caught up market versus actuarial. So that's why we kind of see these contributions tick up a little bit. And based on okay. This next slide kind of shows you the last four columns of that other page on 14. So here, as I said, that top one is 7% and 2.4 inflation. They all have 2.4 inflation, and then the different projection scales are just based on the discount rate that you had me look at. And as you can see, you kind of see the same kind of results. Each one will go up for the next 3 or so years because we're recognizing those asset losses, and then it'll start to trick down. Okay. Any questions on that?
Hi, Stefan. This is Brian at Vanguard. I'm on the line, meaning if you or Carolyn, you want me to comment on inflation or any of our projections, I'm happy to, but just putting that out there.
Yep, Brian, this is a fabulous time for you to weigh in, especially on the three levers, if you will, that we weigh in on: the mortality tables, the discount rate at being 7%, and then the inflation rate. Your thoughts about where we stand on that and how reasonable those assumptions are.
Sure. So I'll keep them brief. So last presentation in our December meeting, we looked at your current asset allocation and we use a 30-year time horizon. We could use any time horizon, but on a 30-year, the median expected return for your asset allocation, basically a 60-40, was 6.47%. But we always look at any distribution, any expected returns in a distribution. So at the 25th percentile, it would have been 7.11. So, it's that 7% target is above our median projected return, but still within what we would say is a reasonable band. If that helps for some clarity, we're pretty conservative as far as our inflation forecast. So we're using a inflation figure of 1.7% over 30 years. I would say from what we could tell is, that's conservative or low compared to a lot of other firms. So if inflation is higher over that time period, well, that would only help the returns, right? Meaning we use 2%, all the numbers I just gave, go up by about 30 basis points. So, that's how I just kind of weigh in on those two aspects.
You said 1.7 you were using, or 1.7?
Over a 30-year, 1.7%, right. We do get data, what other investment managers are. There's people that cobble together. I could take a look at it quickly when I go on mute, but maybe it's in the 2.1 range or so. I think we're more conservative than others from what I've seen.
Brian, would you find it, would you consider it to be within reason, a reasonable thing if we were to hone in on the 2.4 inflation rate within these tables?
I don't, I guess if you went off historical numbers, yeah, I mean, that'd probably weigh in. I don't know if we put a band around inflation. I haven't seen that. I could take a look. I don't think that's far-fetched number. So actually, we do have a kind of a range of inflation. You know, the 1.7% is at a median. Again, if we look at a higher end at the 25th percentile, it's 2.3%. So yeah, I think that's, now that I look at that range, you know, it's within our bands.
Okay.
Brian, quick question on that. So like if you extended your time horizon, would your inflation most likely go up, or would it stay around the 1.7?
No, you're right. So we really do the forecast like on a 5, 10, and 30-year basis. So the inflation over the next 10 years is lower. So yes, so, you know, as we go out to that longer time horizon of 30 years, it goes higher.
Yeah. Okay.
I took a look at the Federal Reserve website today to look at kind of their inflation forecasts, and they're quite a bit lower than this as well. Brian, they reflect a little more of what the Vanguard forecasts are.
Right. Yeah. I think there's,
As Brian said, remember that that's a shorter term. So we kind of look at the long, like I said, this is probably over 60, 70 year that Social Security looks at, which is, and we kind of use that because that's a good baseline. That's a readily available and it's easily defendable, which is why we kind of agree with that one. I'm sure if you're looking at a shorter time frame, so say that the town plan was, you know, nearing its maturity, you would probably use a much lower inflation, more like that 10, 20 year time horizon.
Okay. I would like to, you know, I would like to get to a point where we're honing in on one of these. I'd love to get a sense of everyone's views on kind of the mortality table, the discount rate, and the inflation rate. Before we do that, I do think it's important to kind of bring forward, we are within the band that Vanguard has presented to us with that 7% discount rate. We've also made really significant changes to the pensions here in the last 12 months. We've adopted the new mortality tables. We've brought on our new investment advisor and OCIO with Vanguard. And we've also are out right now with the RFP to update kind of our actuarial services relationships. And so I'll kind of weigh in. I am of the mindset that it might make sense to hone in on that lower inflation number, the 2.4, but I'm pretty comfortable for this year kind of staying with that Pub 2010 MP20 and keeping the 7% discount rate to give us a little more time, given the fact we've had all these changes come in. But I would love to get a sense of how everyone else feels. Why don't I open it up with a motion and then see if someone wants to second? We can open it then for formal discussion. So I'd like to move that we, for our 2020 valuation review, that we adopt the Pub 2010 MP20, the 7% discount rate, and the 2.4% inflation estimate into our valuation. Someone like a second?
I'm happy to second.
I didn't know the mortality table was in play. I thought that was settled and that was the most recent one, so we couldn't even really change it to something else newer. Am I correct, Stefan?
Yeah, you can choose to adopt it or not adopt it. Again, like I said, it's to get that additional savings. Again, it's like 0.5% roughly that the liabilities decrease, and so you can see it has a minimal impact in the grand scheme of things, but it is a savings. So I don't know that if you formally adopt it, then I think, you know, that's the way to go. To put it in your motion as one of the assumptions, you know, because you're kind of adopting all these assumptions at once, right? I understand that correctly?
Right. That was the idea of the motion, was to put all of this on to allow us all to discuss this within the context of the motion, to allow us to kind of follow the Roberts rules a little bit. Tom McCarthy, you second?
I did.
Okay, so let's open that now to discussion. Stefan, can you explain again to Chris's question? We adopted the MP19, and if I heard you correctly, the idea of using these public service sector mortality tables is they get a little bit updated each year. The methodology kind of
Correct.
comes at it each year on a rolling basis to try to incorporate the most current data. And so the MP20 results in a slightly more current read on the expected mortality of the public service sector.
Correct. Yeah, and it's not like they throw away past mortality experience. So really, what they're doing is adding another layer of data on top of that, right? So say the MP19 table may have had data through 2016. MP20 incorporates 2017 on top of that. And again, what these tables, these are kind of a two kind of tier table, right? It's not just age only. It's year of birth and age kind of that they take a look at. You know, they develop these heat maps. And you can go into really detailed things. They even look at location at some tables, right? You know, people in the Northeast tend to live longer than people in the South, right? Just for whatever reason, you know. So they do geographically experience studies as well.
Yeah,
So it makes sense to kind of continue on with the layout, because we've been adopting them each year. Even when we were on the RP tables, we would use those corrections.
Well,
because
okay,
they
but
were the latest that were out there.
I have a question about that because I've been on the board for a couple of years and we had been using the same ones up until last year for 4 or 5 years, is my understanding. And then when we changed this, all hell broke loose that we were making changes. So I'm curious as to why we're now doing this on a yearly basis. You know what I mean?
The key part of that did not change, though. They had always been using, so even when we were using the RP tables before the pub tables, we were using the 15, the 16, the 17 each year. The base table, again, is the pub.
But I don't recall voting on those incremental changes each year.
Yeah, so well, you guys can certainly put it in that we're going to always adopt the latest MP improvement scale, and that would be one and done, I guess. So next year we won't bring it up. We'll just automatically adopt it, and it'll be the 21. And whether that's good or bad, I don't know. I can't predict that future. And that could be, you guys can choose that route, and that would be fine. I think
I did understand, in the point that I think it was such a big deal last year. It was because we hadn't done those incremental changes, it sounded like, and then all of a sudden, boom, we made a big change.
No, Chris, Stefan, if I could hop in, Carolyn, the big change we made last year was in that we moved away from using a blended private sector to using just public sector.
Okay.
But the pension board always, I believe, has a practice of incorporating the most current set of numbers within that methodology.
But we hadn't been voting on those individual years prior to that. Okay. So make sure.
Think of it this way. I think what you did, you adopted, it's a base table, right? It's a base mortality table that you've adopted, right? It used to be the RP table, as Carolyn said, that was more geared to the private sector.
Gotcha.
That was the data that they were using for that. And now the pub table is a new base table, and they're basically, I think they're both in the 2006 base year that they use, and pub is projected to 2010, or the other one was projected to 2014. So that there's just a base table, right? And both tables use the improvement scale on top of that. So that I don't know that you're really changing that, but I wanted to make sure you were aware of that as well.
Okay.
But Stefan, when we adopt this table MP20, on the basis of what you just said, or what I think I just heard, it doesn't sound like those are hard numbers, that those are dynamic, that they're being adjusted year to year. Is that a fair statement?
Correct. Yeah, so I guess you might look at it as we're going to adopt the methodology that the SOA is going to present a new improvement scale each year that we're going to automatically adopt. And maybe that's how you look at it, and then it won't be confusing. So the only time that mortality would really come up is when a new base table comes into play. And that won't be for another 4 or 5 years, I believe, from what they said. They said because they were going to start looking at another one, but it got delayed with COVID. It got pushed back a couple of years before they start gathering that data.
I thought my understanding was I think you said like a 5-year cycle. Well, last time was kind of was for the norm.
Yeah, I think they're gonna. They were trying to do it at 10 years, and obviously I think it had been like 20 years, right? Because before the RP14 came out, it was an RP 2000 table, right? So it was quite a while.
Okay.
So they wanted to do it within 10 years study, right? But there's again now that they've kind of the compartmentalize it a little bit, where now they're kind of focusing on private sector and public sector, and then there's probably a few other derivatives of those sectors as well. So they kind of tackle one each time, each period, for a 2 or 3 year period, and then they put that out. But the latest I heard, what they said, that there's a delay of a year and a half for their next study. So Publix, this table is going to be around for a few years, this base table. Again, because it just came out in the middle of 18, early 18, when it was finally released.
Okay. Is anyone else like to comment on this?
Eric Talp, I just have one question. I couldn't find it in the presentation, and I know you said it. What's our current inflation rate right now estimated at?
1.4.
Currently, it's 2.6. It's in the second column here.
Okay, that's
14.
okay. Thank you.
So from the baseline, the only change really is this MP20. So everything would be the same, except it would be MP19 in the baseline.
So are we going to be revisiting the discount rate at some point in the next year? I mean, within the next go around? I mean, I know last year we said you would never change the actuarial tables and the discount rate at the same time because of the even bigger impact. It does concern me that we're at the upper band of what Vanguard is saying, and we're at 6.4 is what Brian is saying. So there's a lot of difference between those two things, and and again, I'm looking more conservatively, and I think the discount rate is, and the discount rate, get me wrong, Stefan or Brian, that's going to make the biggest impact of the three potential things we could change. That's clearly the big hit.
Absolutely. And to your point, your question, I think you kind of look at it every year, right? To make as Brian kind of tweaks things on how the funds are performing, they move things around, right? And every year you kind of relook at it and say, where is our current asset mix, and what are the long-term rates of return that are associated with those? And so based on your 60-40 target, right? You're still that way, and over time, what's going to happen? You're going to have a deviation between the police and fire plan and the town plan, right? Just as I said, the town plan's closed. So as that plan matures, you're not going to stay at 60-40, right? Because that's heavy on the risk side. You're going to start to drift that down, maybe to 50-50, then maybe to 40-60 over time. And then that rate's certainly going to be divergent from what the police and fire does, right? Because they're two different plans at that point in time.
Brian, did you want to weigh in?
Similar.
Yeah, not so much on the latter point, but on the former one is, yes, we update our capital market assumptions really on a quarterly basis, but the trend, for all clients, this is corporate plans, public plans alike, has been to bring down that discount rate. And most plans have been doing it in a gradual fashion, not all at once.
Right.
And really, it's a testament to where, forecasts for equities, and even more so for fixed income, have come down over the years because we've realized really strong gains, especially in the equity markets. So forecasts, and we're not alone, out the next 10 or 20 or 30 years are lower, given the very strong gains in the equity market since 2009, and that interest rates are at zero, and so there's not much gains to come from fixed income. So I think plans have been tackling this in a prudent manner to bring that discount rate to something more reasonable and doing it gradually because of the impact it has on planned finances.
Brian, would you recommend at this point that we also that we lower the discount rate at this point? I mean, my concern is we've put a lot of change into the plans. We're relatively new with you and the kind of the new investment vehicles.
Right.
And I would absolutely look to adjusting the discount rate once we're on the other side of this, once we've had the full cycle with you, and once we've had once we're back with the RFP with their new kind of actuarial relationship.
Right.
That I would revisit it then. But please.
I mean, I guess the high point is it's on the higher end of our forecast, but within what we would consider a reasonable band. If it was outside of that, maybe that 25th percentile, I would say maybe look at it a little bit harder. I think it's reasonable, but realizing, there is a financial impact of doing that and what it does to projected contributions, and not knowing what the state of or how the county's finances is being impacted by a COVID perspective. So it's kind of a non-answer because I don't really have a full grasp of the financials. But from an investment standpoint, it's still that 7 is still within range. But knowing if we're looking out to the future, I think a gradual reduction over time makes sense.
I would agree. I mean, I think, and again, this is the other side of the coin that I'm not very familiar with, but I would think that we would need to. I'm sorry that Brenda's not here, but because I hate dropping stuff that we could be taking, making a financial change to the town, but we need to let them know that this is what we're looking at. And I don't know what time that they think that this process would go into place. Do we need to vote this where this would fall in the budget cycle that they would need to know that we're doing this? But I think the note needs to go out somewhere that the discount rate is up for potential change in the next 12 months, if not earlier.
Is our CFO on? Jared, are you on? Okay, maybe we don't have him. And First Selectwoman Brenda wasn't able to join us. Eric Caliper?
Yeah, I was going to jump in. I kind of agree with Chris. I envisioned last year of, I know there was a lot of talk at different town boards about reducing the discount rate, bringing it down 10 basis points in every year. Gradual change, I think, would be welcoming. I think it would be something the Board of Finance would actually, appreciate. And I think I would feel better about it. I think that, again, I think we could capitalize on that, recognizing the 2.7 inflation rate and, make that drop a little more palatable.
Hi, this is Jared. Can everybody hear me now?
Yes.
Yes.
Okay, good. Because I was trying to talk before, and I guess my phone automatically muted me, and so I had to actually press the *6 button. So the administration, First Selectwoman, we're aware that this is a conversation that's going on with regard to lowering the discount rate, and think that something should be done at some point in the future. I agree with the chairman that this is not the best time to do it, just because of the there are a lot of moving parts right now, and we would like to be able to see what the impact and what the performance is of Vanguard, and get a good picture of that, so we have a baseline to work off of before we start making other changes. We just as has been pointed out numerous times, made the changes to the mortality tables last year, and that predated me. But so these are some big things that happened, and I would like to move forward for purposes of this valuation and not change the discount rate and leave it at 7%. It is within that band, as Brian pointed out, albeit on the higher end, but certainly reasonable. But definitely to continue the conversation and talk about, because there has been talk about lowering it in previous meetings, and the range of, do we go to 6.75? People have even been as low as 6.5, which I think is way too low. But to have a more substantive conversation about, okay, if we want to change it, what's the right increment to change it by? But for now, I would support the chairman in adopting or recommending whatever that the motion is, to stay at the 7% discount rate and the 2.4% inflation rate.
Jared, let me ask you, what is a good time to begin to talk about this? I mean, I don't know, we're in the budget cycle. Can we revisit this next meeting or in 3 meetings from now and say we want to change it then? I'm not saying we're doing that, but I'm saying, is there like we need to know July 1, we need to know by August 1st, October 1st, and when we need to kind of, what time frame we're looking at here.
Yeah, I mean, for me, I would, I think we should wait until probably early summer, late spring, sometime after the budget is adopted,
Okay.
and to look at it as a possible option for the next cycle, because at that point, and we'll get to some of these other things. Some other things that we're going to be talking about later in the agenda of some other changes that we may be undertaking and getting more information on and researching over the next few months that are going to occupy a lot of our time as well. And so it's just, I don't know, I think it's a lot to take on.
Okay.
Can I add something? I was looking at other towns, in our neighborhood, the Fairfield County towns, and we're much higher. Darien, 6.375, New Canaan, 6.75, Westport, 6.1, Weston is at 7 like us, Greenwich is 6.5, Wilton, 6.88, Ridgefield, 6.75. So, we'll be prepared to take an even bigger chunk. If we're going to say, we're not going to do it this year, we're prepared to take a bigger chunk next year.
Right.
Or maybe it makes more sense. Every year we bring it down slightly, and it gets into a new routine. Nobody likes change, but, eventually, somebody's going to wake up and says, we're now you're going to have a credit rating agency that says, you guys never produced everything. And when you kept paying it off, and every year, something else comes up. It's a bad year. Maybe we start bringing things down. And the interest rates are not going up. It's with what's going on, it's going to be an extended period of low, continuing the quantum easing. With the support of the Federal Reserves and central banks around the world and stimulus. So, something to think about.
Yeah, Eric, if I could weigh in ahead, I would be more than happy to schedule just as a single item agenda, even for our July 28th meeting, because we'll have the actuary RFPs will be in, we'll be out of the budget cycle, and we can just make that the sole purpose of the meeting. To go through and set that strategy. And at that point in time, I would love to seek the input from the Board of Finance, from the administration, and really get the number to where, we think the number should be. Right.
And I think looking at those other towns, we probably need to look a little deeper at what else and what the rest of the context is for those other towns, because they're also considering mortality tables and inflation rates, and so to just look at it and just look at their discount rates is part of the picture, and it's a big part of the picture, but that I think that taking a little more time to dig deeper into those and to figure out what else is going on there is important as well.
Yeah, I'll make a general broad comment on that. Brian Scott's done some analysis, I think, shared in the past, just of the towns in Fairfield County, and something that drives it is where they are, the funded status. So some of the plans that are more or well-funded, not that Fairfield is not in a good funded position, but some plans are certainly in the 90s or 100%, maybe a little bit more conservative with their allocation, and that could affect their discount rate. And then just, and just a philosophy of being more conservative. So I think what I'm hearing and kind of is resonating with a lot is, in the future, it's likely that the prudent to bring the number down over time, but consider all the factors.
Any other comments on this? I would love to know the perspective of some of our newer members to the board, Kevin Chadine or Nick Caruso. if you'd like to kind of weigh in. And also, Jack Mahoney, you've been on this board a long time. I'm wondering what your thoughts are. And if you're muted, you will have to unmute or *6, I guess, if you're on the phone.
How about now?
There you go. I hear you, Jack.
Okay. All right. Well, I'll say that again. So I do agree that we should take a look at the other towns in the context and what's going on there with those lower rates. But I do agree with Eric that I think it was Eric. Is it Newman? Eric Newman?
Yeah, Eric Newman. Yep.
Yeah. So I do agree with Eric that at some point we're going to have to kind of face up to this, and I do think that we are on the higher side. But I think, Carolyn, to your point about maybe taking a look at this as a sole agenda item, maybe in the summer, is probably pretty smart, and buying some goodwill with the Board of Finance and being sure that everyone is in lockstep makes a lot of sense too. So I think my 2 cents would be, yes, let's address it, and I'm going to be favorable upon probably lowering it, and probably Eric Kelper probably lower than 10 bips, but to be determined.
If we go to July, right? Should we make it like every year so everybody in the town, everybody knows every July meeting this is going to be going on. We're going to look at this thing every year going forward, and eventually, so it's no surprise, and then they could give their input, have plenty of time to do their own research.
Eric, I think that's a great idea. I think we just annualize that this is something that we talk as a single item agenda in July for that July meeting. All right, guys, if there's any other comments, I do want to make sure, let's see, we don't have any thoughts from anyone else.
I have nothing original here. I agree with what's been said. I think the 7's not quite realistic, and we're hanging our hat on the fact that it's, within bandwidth. But even in the same breath, we think collectively it's a little high. I think we can make a modest adjustment to it at some point in time.
Okay, thanks. That was Tom McCarthy. Okay, so in that case, if I could call for a vote. So the motion is to adopt the Hub 2010 MP20, 7% discount rate, 2.4% inflation rate. If I may ask, how to do this? All those in favor, please say aye.
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 May I ask if anyone is opposed? And if you are, if you could also state your name.
Eric Caliper, I'm opposed.
Okay, and do we have any abstains? If you would, say your name. No? Okay. Thank you, guys. And make a note that in July we will be having this as our as our topic of discussion. All right. Stefan, thank you for your help.
Okay. You're
Thanks.
welcome.
Okay, let's move forward, guys. Next up is our performance review. This is Brian from Vanguard who's going to take it from here. Do you want to share your screen, Brian? Brian, if you're speaking, I think you're still muted.
Okay, I couldn't do two things at once. I was trying to share the screen and I was still on mute. So let me know if the screen is still up. Is it up? Okay.
Yep.
Good, thank you. Hi, everyone again. Let me first just check in. I have the agenda page up. Let me just check in, given time. So yes, we do have plan performance as we usually do, as we'll always have in these meetings. But we had two other items on the agenda. One was to look at the OPEB asset allocation, mainly within the fixed income piece. We've spent really all of 2020 to talking about the pension plan. And so we wanted to talk about the OPEB asset allocation. And again, it's mostly the fixed income. And then there was also a request, given that Peoples is exiting some of the, I believe it's both the custody and the pension payment services, to talk about Vanguard services there, since we do offer that with clients. So those are the three agenda items. And Carolyn or others, just look of how quickly you want us to go through something. Do you want us to do it in a different order? What would be best for you and the board?
Brian, thanks for asking. We'll get to the custody and pension payment later. I would, if you could do the recap and the performance, and then the fixed income right in the order you have, would be great.
Okay, good. Let me, I'll turn it over to my colleague, Brian Scott, and he'll just go briefly, again, in the interest of time, just to recap the markets, and then I'll get into the actual plan performance, and always welcome someone interjecting as we're going through this. So I'm, unless someone's got their own book and not online, it's page 4 of the Vanguard presentation.
Thank you, Brian. Good evening, everyone. I'll keep this brief. Just a quick recap of the global markets. So in Q4 of 2020, U.S. stocks had double-digit returns of 14.7%. But for the first time all year, we saw non-U.S. stocks outperform U.S. stocks at 17.2%, about 2.5% difference there from non-U.S. to U.S. stocks. But on a year-to-date or one-year basis, U.S. stocks outperformed non-U.S. stocks by about 10%. Next page, please, Brian. All year long, we've been talking about a trend of large cap growth stocks outperforming mid, small, and value. But in Q4, small cap stocks had its best quarter ever in the history of the Russell 2000, returning 27.1%, which was good. It really helped small caps catch up to the large cap performance on a year-to-date basis, still lagging, returned 19.1% versus 21.5%. A similar story on the value versus growth. Value finally outperformed at 17.2 versus 12.4% for growth. But as you can see on a year-to-date, one-year basis, growth 38.3% versus 2.9% for value. So still a long ways away from catching up. Next page, please, Brian. And then on the fixed income side, we saw muted returns in treasuries and government securities. But as we moved out on the credit quality or the risk spectrum, we saw investment grade credit return of 2.8% in Q4, and high yield returned 6.5%. If we look at it from a maturity standpoint, we actually saw the long end of the curve steepen quite a bit. And you can see that negative 3% return in long-term treasuries. So as the yields increase, the prices of the securities go down. But on a year-to-date basis, investors fled risky securities, picked up treasuries. You can see a 17.7% return for long-term treasuries on a one-year period. That was very quick. Any question? Oh, one last slide, sorry. This is just a recap with some notable events that took place in 2020. We managed to put all of the notable, or at least I think notable, events on the one slide. You can see, so letter J, for instance, was when the Senate passed the CARES Act. That really is what the $2 trillion bill really helped drive the market upwards. And then I'll just call S&T at the very end there. I think that's what we've all been waiting for, some positive news in 2020 with the vaccines showing a great efficacy and promising for all of us, really. And when Vanguard looks at our projections, I think Brian may have shared with you the economic outlook for 2021, it really hinges on health. We see economic growth being linked to can we start to return to somewhat of a normal lifestyle. So S&T was definitely notable for 2020. Any questions on any of the slides we covered so far? If not, I'll turn over to Brian to review the plan's performance.
Thanks, Brian. Yeah, so, piggybacking on the actuarial conversation, I'll focus on the fiscal year-to-date numbers. It was very muted when we ended the fiscal year in June, but, all the rally that Brian has talked about, fiscal year-to-date, strong double-digit returns of 14.52% for the pension in those last 6 months. Very close to the composite benchmark. The composite benchmark is made up of these indices down below. Some of the underperformance is really captured in the first half of the year. Primarily what was driving that was, the poor returns that happened from Allianz, which was a big portion of the US equity allocation. As we'll get into just a moment, our equity and fixed income portions are now all passive, all indexed. So, really going forward, any underperformance or outperformance is going to be driven by the alternatives managers that we have in the portfolio. So at least a really good story as far as absolute performance the last 6 months. If I take a moment to look at our asset allocation, where we are against policy indices, we're very tight and very close to all of our policy targets. We have a lot of cash flow that comes in and out of the plan each month, and we use that cash flow to rebalance to those policy targets. Beyond just cash flow, we're getting distributions as well from some of the private equity managers. That's other cash we put to use. Regarding cash, you'll see an amount of $3 million or 0.8%. That's really, we're trying to keep the cash close to 0%, to be honest. It bumps up towards the end of the month, and this is, of course, a month-end statement, because we're raising cash in that last week of the month for benefit payments that are going out the first. So cash looks high, but it's really just because it's happening, that cash raise at the end of the month. So as I move into a more granular look at, what's driving the performance, the absolute, or more importantly, I'll talk about the relative performance. The 4 index products, the total stock market, total international stock market, total bond, and total international bond. Those decision was made last June to go towards that passive approach. So they're all very, very close to their tracking their index. As far as some return dispersion, and the absolute and the relative number is the private equity. And not that private equity is performing poorly at all. It's doing quite well. The fiscal year-to-date performance for the private equity portfolio is 19.9%, but it's trailing the public benchmark. The last 6 months, that Russell 3000 index has performed really well. So there's some lag in the short term, but if you look at the longer term numbers for the private equity, they've been over that public equity benchmark plus 3%. Remember, these results are all as of September 30th for the private equity and the private real estate, because it operates on a quarter lag. If I look also in the private, here are the 5 different private equity funds that are held by the pension. And you'll see a wide range of different returns. And this refers to, at least in, you'll hear in private equity a term called J-curve. And that's because in the beginning cycle of a private equity fund, such as this Lexington Middle Market Fund, which is only seeded back in 2017, they're not yet realizing any investment. So it's very typical to see a negative return early in the life cycle for a private equity fund. But if you look at some of your longer dated investments, you'll see much higher returns, on a fiscal year-to-date basis. I want to address one question that came up last meeting and said, is there another benchmark that we would use for the private equity investments? The 5 that you have here are heavily weighted towards US based. So I think that Russell 3000 index is still an appropriate benchmark. If a private equity fund had more of a global exposure, like the HarborVest fund that I've talked about in the past, then we might want to think of a global benchmark. But right now, I do still think that Russell 3000 as a public benchmark makes sense.
Okay.
Bern, does it make sense to find out what the various funds how they're benchmarking against their internal is in their like quarterly reports? It says it's how we did against this benchmark, and does it make sense that we sync up with what they're doing? So it's more seeing how that particular each fund is doing against their managers, how they're performing versus taking a more of a broader approach.
It does, Eric. I think we'll look to build that over time. I flipped ahead. I'm going to go back and forth, but I flipped ahead one slide. This is a new slide that we created that reflects all of the private equity investments. It shows your commitment date of when that was made, your total capital committed, and how much have been contributed so far. So some of the funds that you see that were funded back in 2012 and 13, very mature as far as most of that money has been committed and we're getting a lot of distributions. The funds more like 2017, they're still calling capital. And so, Eric, here are different return metrics that private equity managers use, especially this internal rate of return. So we've looked to build out some of the metrics or different performance measures to give you a picture of these different investments.
Thanks.
I'm going to go back a page just briefly and touch upon the private real estate holding with Principal. So from the third quarter, real estate, no surprise, has been, still been weak. A lot of pressure in retail and malls and sector, even student housing. So the last quarter or third quarter, there was still negative return for Principal. The Odyssey Index did post a positive return. And on a fiscal year to date, it's a negative for both the index and for Principal lagging the index. With that said, very recently we've gotten a flash report, not an official report from Principal, and it looks like returns have turned positive for the real estate sector and Principal as well. Though I don't know how they're performing on a relative basis. That'll be another month or two.
Okay.
One other comment that might have been seen in my email if it went around as far as the benchmarking for the Principal fund is historically through the Callan reports, you see it's been using an equal weighted benchmark, but we believe in using a cap weighted benchmark. So just like we do in the public markets, most benchmarks are cap weighted. So instead of equally weighting all the real estate managers to do more of a market cap based approach as far as the proper benchmark. And I'd note that the real Principal also benchmarks themselves to a market cap weighted benchmark, not the equal. The returns are not vastly different, but they do differ between the two indices. So I would just make a motion to use the what's referred to as the NFI Odyssey benchmark, which is a cap weighted and which Principal uses. Unless there's some historical context of why that was chosen in the past, what some board members have been on. And last comment on that is we can show both, two indices if it helps the committee in evaluating it.
I think it's fine. I'm
Okay.
happy to see the benchmark that you recommend.
Okay. Yeah, I think that makes sense.
I don't know if anyone objects to that. No. I don't think we have to take a vote on
Okay.
that. It's just a presentational
Right.
benchmark.
Okay, I talked about some of the private equity commitments. I jumped to the OPEB performance, and on a fiscal year to date, up 18.4%, so very strong on an absolute and relative basis. The reason why, as a reminder, it differs from the pension plan is we have 10% higher allocation to equities. So looking at the policy benchmark, we have 70% to equities, 30% what we would call risk reducing. So that's both fixed income and real estate. So that's what's driven the higher absolute returns for the OPEB plan. If I turn to the next page, the only active manager, and this will be a topic of conversation, is PIMCO. So PIMCO, on a fiscal year to date, has done very well against its benchmark. That's a reversal from where it was in the beginning of the year, where they were the first quarter they were behind benchmark by about 300 basis points. When I look at what's driven that performance, there's been a lot of out of benchmark performance. They've have a heavy weight in mortgage-backed securities, probably about 30% more than the index, and in this environment, those have done really well and helped their performance. And I've already touched upon the real estate return, similar to same fund, similar to the pension.
Going back
I think it's pretty extraordinary that our fiscal year to date, a 6-month return, the equities were up 25%.
Yes, and even more astounding is the return off the lows. So we have an inception date of performance in here. That's because that's when we started reporting from Vanguard. So we have an inception date from when we started with Vanguard. And look at it, it's just an astounding, that was close to the bottom. The market bottomed the last week of March, up 35% since that time. So quite astounding. I skipped over this page on the OPEB. There were about the cash allocation here. There was a contribution made to the OPEB plan the last week of December. So that's why, again, you'll see a high allocation of 2.5 million. We got that invested, and we're really close to 0%. We have plenty of liquidity in both of these portfolios. We can raise cash within a day or two.
So one of the questions on the OPEB allocation, right? I mean, we talked about this at the last meeting. We are quite overweight equities in OPEB relative to our allocation in pension. That has obviously and clearly worked to our fund's advantage here over the past month and a half. Wondering if you would recommend that we maintain that allocation or we lower it. We take some of the money out of the equities.
Mm-hmm. Sure. I don't have the historical context, but I'm going to surmise of why there is a more aggressive posture in the OPEB plan. And I think that's being driven by the funded status. I think the funded status for the OPEB plans, don't quote me, maybe Jared can jump in, but maybe are more in like the 30% range. So, much more poorly funded. So therefore, a more aggressive approach could make sense, and I think could be easily justified for the OPEB plan, and still a long-term horizon. So, generally speaking, again, without more context, a 70-30, given the funded status, certainly could be justifiable looking at the asset allocation as it stands.
Right.
My understanding is that there is a plan through contributions over several years is to get that funded status improved. And so as we continue to get contributions like we just did in this about a month or so ago, I think as that funded status improves, that could be a driver for reducing the risk of the portfolio. That would be my general observation and thought process.
Yeah, OPEB, this is Eric Newman. OPEB for fire was, I I guess at the last time on the website of the published CAFA was at 31.4%, and the town side of OPEB was at 37.9%. So it is under 40%, funded. So
Right. So as long as, and I don't have any reason to believe otherwise, that time horizon is still out 10 years as far as our time horizon, and given the funded status, notice that there'll be more volatility with the higher equity allocation, but certainly I think it's still reasonable.
Okay.
Are there any other thoughts or concerns in not maybe building into that thought process?
No, the only thought that I have, Brian, is if you were going to make an allocation change, or we were going to reallocate the assets a little bit, I would love to do it at a high level, right? The equity is kind of at a high, which clearly we're at. Doesn't mean they won't go higher. But if we were going to look at taking a little bit out of the equities and applying it to the global fixed income or the real estate, this might be a timely time to do it, maybe this month or next month. I mean, maybe you'd want to give some thought to that for our meeting next month.
Sure. In just looking at our value, first we always try to take a longer term approach, because we really don't have a good sense of what the market will do from month to month or quarter to quarter, and that's why we try to stay focused on those 10 or 30-year projections. But also looking at valuations, with the exception of some growth stocks and some tech stocks that I'm sure everyone's read about, the general feeling from our economics department is that valuations are, let me see if I have something in the presentation, are really within a fair value range here on page 32. Certain growth stocks, given how much they have run, clearly look more expensive, but generally we feel like they're in this fair value territory. Now, we did have we did have a strong fourth quarter, but we're not seeing, or we don't feel like there's a bubble territory that we feel like maybe is a good time to take things off the table. What I did want to touch upon on the fixed income allocation with regards to the OPEB is, again, from historical context, back in June, we shifted our public equities and public real estate to an all passive approach. So the recommendation really was to mirror those same fund lineup and that same structure in the OPEB plan as we do in the pension. So in the pension, as you saw, we have the total stock market index and total international, but we do have a passive approach within the fixed income. And so what I've put forth here is to bring that fixed income portion of the OPEB plan in lockstep with how the pension is invested. Now, you're not going to be the same absolute numbers because of the different asset allocation that we talked about, but what it does reflect here is the split between US bonds and international bonds at a 70%, 30% allocation. So US bonds here in this recommendation is 70% of the fixed income allocation, and the 6% reflects the 30% of the total fixed income exposure. So it's not changing the overall split between what we call return seeking and risk reducing. It's not changing the allocation to real estate, but just looking at the actual funds that are employed in the OPEB plan.
And in order for us to do that, we'd have to take a vote on it.
That's
right?
my understanding. Yeah, that's
Okay.
my understanding.
I'll make that motion. I'd be happy to make that motion to reallocate the OPEB fixed income portfolio to be in line with the pension portfolio, which is to say to effectively move out of the PIMCO Global Bond Institutional Fund to then split the assets to the Vanguard Total Bond Market Bond Index Institutional Plus and the Vanguard Total Institutional Bond Market Index Plus or International Bond Market Plus. Someone like to second that?
I'll second the motion.
Okay, thank you, Tom McCarthy. I'm happy to open to discussion or comment. Okay, hearing none, I guess. If we can move to a vote. All those in favor, please say aye.
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 Okay. Can I ask anyone opposed? If so, if you could please state your name. Okay. Any abstain? No. Okay, that motion passes. Thanks, Brian.
Okay. I did have some, again, I'll take your guidance. I included some slides on fixed income just to give some context of how we think of it. You notice that we do use a hedged benchmark because of the volatility that currency can bring in. So I just wanted to, last time we spent some time talking about our equity approach. Some of these slides are to talk about the fixed income approach from an educational standpoint, just broadly speaking. Again, in the interest of time, would you want me to cover those briefly, or do you want to move on to the custodial or the pension payroll?
You know, I'm happy if everyone's all right, kind of hanging in there. I don't think we've had a good fixed income review for a while, and you'll do it at a good clip.
Yeah, right. So thank you. And again, please interject with questions. But I talked about the split between U.S. bonds and international bonds and how we think about that. When you look at the global capital markets, actually international bonds make up a much bigger portion of the market cap than U.S. bonds. But we don't believe that you need to be a market cap weighted on the fixed income side, that you can get ample diversification. And right now our best thinking is that 70-30 split, that you get enough diversification by just keeping a 30% allocation to international bonds. And even if you look at our forecasts for international bonds, they are below that of U.S. bonds. So right now we think that that's a good mix. But if our philosophy or our methodology changes, that will be reflected and brought to the committee. The next page, on page 19, this is just preaching the benefits of diversification. So we do believe in having international bonds, and you just see that that cycle does, and that performance does vary over time, and therefore keep a global approach. Maybe right now all central banks are doing the same thing and will for the next few years of keeping rates low, but you really do have different interest rate and inflation environments, and therefore talking about that global approach. The last part I hit on is when you look at the benchmark that we use or even PIMCO used, it's very common to use currency hedging in fixed income as far as the benchmark, because the currency volatility can overwhelm the volatility you get from fixed income returns, which are, as you know, pretty low. So when you look at unhedged returns, as far as the annualized volatility is much higher, and because the currency drives an overwhelmingly large percentage of that. You know, if you have fixed income returns of 1 or 2%, that's all you're forecasting. We know currencies can move a lot more. So that's why we follow currency hedging in the fixed income markets to keep that bond-like volatility. We don't want to have international bonds being just as volatile as our equities. So just wanted to give some context there. And then as far as, you know, Vanguard's fixed income group, you know, on behalf of all the fixed income that it managed, we're talking about 1.4 trillion in assets globally. It's a very large fixed income department of 175 portfolio managers and analysts. So I just wanted to give that context of Vanguard's fixed income team. I won't spend any time on here on the fact sheets, just at a high level in the sense of, just as the name implies, like our equity funds, total bond, you're getting very well diversified portfolios here, 9,900 securities. And if I were to flip over to the international side, again, 6,000 different securities. So you're getting a very diversified portfolio across both of those. Carol, I'll turn it back to you if you want to head into this last section.
Yeah, thank you. Let me just pull up the agenda. We're going to Brian, if I'm going to ask you to kind of hold that slide, if you could kind of unshare right now.
Unshare,
Jared,
okay.
Okay, Jared, if you're there, I'm going to let we'll pick that up as part of the CFO update. And then Brian, because I want Jared to be able to kind of give the background of why you have that slide.
Okay, so I stopped sharing.
Okay, thank you. Hey guys, thanks for hanging in there. I know it's late. Jared, if you're available, the CFO report is up next.
Yes, can you hear me?
Yep.
Okay. All right. So trying something new based on a recommendation, I think, from somebody during the last meeting, and rather than have me sit here in my kitchen and rattle off all the different transfers, put it to paper so you guys can actually see this. And so, but I think it may require a little bit of explanation. So let me do that really quick so everybody understands what's going on here. Okay, so we have within People's Bank, we have a fire and police account. So I'm just going to kind of cover what the different accounts are. There's a fire and police pension account, which is number 2024. Those are the last four digits. There is a town account for the town pension fund, which is number 2016. And then there's what is referred to as a funds account, number 2081. I'm not sure that, I think the best way to describe that is sort of a hub for the other different accounts. There's a couple of OPEB accounts as well, which have a lot less activity, so I didn't include that in this written report. I can in the future if you'd like, but they don't have the same type of activity typically. So there are also sort of mirrored OPEB accounts as well, one for police, one for police and fire, and one for the town. So the way to read this, just to kind of explain the mechanics of it, if you look at the first line on December 4th, 2020, there was an internal transfer that came from the fire and police account and went into the funds account, and that the value of that was the dollar amount was $70,641. And then there are a couple other ones that don't have account names. For example, if you look at the pension payments and you go to the first action labeled pension payment, which is comes from the fire and police account to the retirees. So I think that's pretty self-explanatory. It's a pension payment from the fire and police account to the retirees in the amount of, in this case, $1,046,426. And then skip down to yet another, I'll say, type of action would be the employee contributions into the different accounts. And so you'll see the first employee contribution on January 12th from the town employees making a contribution to the town account at People's Bank 2016 of $508,853. And so that, as I'm looking at this, I'm thinking that's probably maybe shouldn't be labeled an employee contribution, but rather a contribution from the town That's probably a better characterization of it, not an employee contribution. So that is that's sort of how to read this. You can looking at these, get a sense of the ebb and flow and the rhythm of the way the funding works for it. There was the pension payment on the 4th, on January 4th. Was kind of set up by the funds payment on the 23rd. You see it on December 23rd, the funds payment into each, the town account and to the fire and police account, to set up that, to make sure that there was sufficient funding in there to make that pension payment on January 4th. And so that is kind of the way that that these things flow. There was a little bit of hiccup as a result of the VRIP participants going into this. I think it basically threw off the pattern a little bit, and so there are some small adjustments here in the first week or so of January. And so you see those small things of about 26,000 and 3,000. Those were to like I said, some small adjustments to make sure that there's sufficient funding in there for the VRIP and the fairly, I'll say, relatively high influx of people into the retirement accounts. So I don't know if anybody has any questions about this. I will, or if you see maybe a better way to write this up, I'm open to it. I actually played with some diagrams and tried to create some shapes and stuff and draw arrows, and it was a mess. So this is what I ended up settling on, and I think it works pretty well.
I think it's fine. I think it works. Thank you, Jared. Hey, Jared, would you mind, since you have kind of the floor here, let's have you roll into old business, the RFP update.
Yep. Okay, so on the update of the RFP for the actuarial services, so the responses came back from a number of, I want to say there were 7 or 8 respondents to the RFP, and each of them had a fair number of questions about it, which we have to respond to. And we've set a date, I believe it's for about a week from today is the deadline that we actually had to extend it a little bit because the questions that came back were pretty numerous and have required a bit more research and work on our part. And so we're delving into that and going to have the responses to the questions from the actuarial consultants that responded and asked the questions by about the middle of next week, I believe it is. And then we'll wait to see what the hopefully from that we'll get some actual bids that we have to review at that point. I don't know if there are any questions about that, about the actuarial RFP. If not, would you like me, Chairman, to move on to the?
Yeah, why don't you move on to the custodian and payments discussion, the new business?
Sure. Okay, so we got word from People's Bank, who is currently our custodian and the institution that processes the actual pension payments to the pensioners. And so we got word from them that they're getting out of that business. They're getting out of the custodian business and in the pension payments business. So we are going to have to find another option to do that. It kind of, but it actually, there's a lot of overlap here, and I guess there's another a subject and service that has come up in the past, before this
predates me, but the idea of having a trustee plays into this as well. And so, and then I guess there would be probably a fourth element to this. So we got the custodian, the payments, the trustee, and then there could be a fourth service which includes more of the administrative part of figuring out how much the payments are and making the calculations and doing those. That could be done by the company that the institution that makes the payments, but in some cases it's not. And so I think our goal and the approach that we're going to use going forward is to look at all of that and figure out what we want to do if we're comfortable with the situation that we are in, or if we want to do an RFP and for which ones of those services, and if we want to do all four of them, or maybe we decide that we don't need to bid out for a trustee, so we just do the other three and issue an RFP. So that's kind of, I think, what we want to work on. And as I referred to earlier when we were talking, some of the things that we may be working on over the next few months, that's it, and it's going to take some research. In the meantime, I think right now what we want to do is, because People's Bank has formed a relationship with a company called PenChex to do the issuance of the payments, of the pension payments, that as of right now, the thinking is that we would go that route. We're still getting a little more last minute research to determine if in fact that's the best way for us to go as a temporary solution until we can do an RFP for everything. But right now, that's what we're thinking about doing. Did I miss anything?
No, that was it. Then so we reached out to Brian Binkley here and asked what Vanguard does, because this is part of, they provide services like that. And so we will, kind of come back around to you as we learn more about the various options available, but we want to make you aware of it. Maybe, Brian, you can just spend a minute or two and share that slide back up from your presentation about the capabilities that Vanguard has, kind of that we would have available to us if we chose.
Sure. Can you just give me a thumbs up or that it's up?
We see it.
Okay. So good, thank you. So Vanguard, our institutional advisory services, we provide, I guess you could say, 2 or 3 of those 4 services. We certainly play a role as custody for our assets. Again, I'm just talking about our OCIO business, or our discretionary institutional advisory service. So just to give you a sense, our OCIO business is about $63 billion as of the end of last year, over 1,000 clients. We serve as custodian for well over 90% of those assets. So custody is something we do. We do not charge our clients at all for any type of custody of those assets. We do play a role for plans that want to or need a trustee. That's usually at the individual level. So we do that for our clients as well. This is some data just on the bottom half of the page as far as our expertise, or how many plans that we do and how long we've been doing our trustee services. There is a separate asset-based fee for being a trustee if plans want it or need it. And then the third piece of that is we do pension payroll. We have a very big corporate pension plan business as well as public plans. And so we've been providing, at the bottom half of this page, we do pension payroll and have been for our clients since 1996. You could see we have 183 plans signed up that we do that for. You could see amount of transactions that we do. So certainly a lot of our clients take advantage of that, by having it all together. It's coordinated, and it's a very high level overview, but wanted to give you a sense of that we could do custody, we could do trustee, we could do pension payroll, or any combination of those, really. We don't do pension administration, is what it's sometimes referred to. Vanguard exited that business. I don't know exactly how long ago, maybe 5 years or so. So of the 4 services that Jared talked about, there's 3. So we do a lot of that for our clients, given it's a big part of the coordination and the efforts of staff to do all of that.
And if I could just follow up quickly on a couple of things, just to give a little more detail to the situation. So Peoples want to, they've given us a deadline of March 31st that they would be out of the pension payment, issuing the checks out of that business. They're a little bit flexible about that, but still we're going to have to, work kind of quickly to meet that deadline. And I believe their deadline for the custodian business was the end of June or July. So we got a little bit more time on that. And as we, as we're looking for a temporary, a short-term solution, the things that were probably the biggest thing that we're keeping in mind, again, for the short term, is to make sure that whoever we go with, it's seamless to the pensioners, so that they're not surprised by anything. They would still continue to get their checks at the same time as they would now, and also to obviously inform them that this change is happening, and to just to make it as seamless as possible for them in the short run, and then we can explore the questions of, okay, what are these 4 services? What do they include typically? What do they mean? And then and also go into, okay, who offers them, and who offers? Does anybody offer all 4? It's going to be kind of a hodgepodge. There might be a company that offers 2. Vanguard was just talking, they offer 3. So it's really a mixed bag. So it's something that we need to spend a little time sorting out.
And I just wanted to provide a little context, as far as given your timing, and I know there's a process to follow. Just wanted to give some context, because it's so important. Is to set up as custodian, that really could be done in about 2 weeks' time. Given when you're thinking through all of your processes, so that's something is really just more of a paperwork issue. The pension payroll part of things, that's where our team certainly looks for a longer time frame, more in the 60 days to get set up, because as Jared mentioned, you really want to make sure that is seamless and set up properly, so it just goes smoothly. And really to turn on those services, I would just budget roughly 60 days lead time for doing pension payroll, as a rule of thumb.
Okay. That's helpful. Thank you. You guys, if anyone would like to, let me know if anyone would like to kind of step in and help Jared and kind of help us gather the information required so that we can kind of bring forth a good array of options for us to vote on as a pension board. We're going to have to move pretty quickly on this. Although it's nice that Peoples has offered a little bit of flexibility. So originally we had thought we would be under the gun here for March 31st handover. But on that front, they're willing to be a little flexible.
Yeah, and I'll also offer that I'm glad to get any leadership on the phone from Vanguard side about these 2 services or 3 services. I work hand in hand with both of the managers that lead up those 2 groups, but that's not my expertise clearly. So if you need to get someone on the Vanguard side of what to think through, what to consider, we're just a conference call away to give some more. This was to give a high level overview of it, but want to get into any more of the weeds, we're happy to do that.
Thank you. I think we're going to have to look at, we'll probably have to go through the RFP process. We are a public municipality.
Right.
So the RFP process is likely to happen for us. I thank you, Jared, for identifying and working with Peoples, and then their request, their firm that they recommend, Penchex, could take us on as a temporary client. And so that there's an option for us as well while we pursue the RFP.
Yep.
Okay. Does anyone have any comments or additional thoughts on that? All right, you guys, here we go. Last item then on our agenda. Thanks, Jared. A proposed calendar schedule of JRIB meeting topics. I want to thank Eric Caliper for this idea of let's, kind of set ahead of time some agenda items that we'll be covering. I'm just going to read them out to you guys just for food for thought. And if that resonates with you, I'll send out kind of an email to everyone. But the idea was that, next month for February, we'll cover the OPEB actuarial presentation. We'll begin to review our investment policy statement, our IPS, and the asset allocation. We also will go into executive session next month for the Allianz issue. So be prepared for that. March, we'll continue the IPS discussion and asset allocation and take action as needed, as warranted. For April, plan on alternative assets overview. For May, continuation of the alternatives and take action as warranted. For June, we'd like to put on that agenda the 401A 457 plan review. For July, we're going to be talking about the discount rate. August, we don't have a meeting. September, we'd like to talk about any pending legal actions and have our presentation by Pomerantz, who's our legal securities monitoring service. For October, we treated to an actuary presentation with the June 30 numbers to the best that they have, and we can talk about changing any asset and liability assumptions as well in October. And then December is the election of officers, the conflict of interest, and if we're lucky, a holiday party and no more Zoom. So fingers crossed on that one, guys.
Amen to that.
But I wanted to kind of lay this out a little bit, just to give you a sense of kind of the topics that we'll cover. And again, hats off and thanks to Eric. Eric?
Yeah, if I just want to speak to a little bit of the background. So I'm probably the longest standing pension board member here right now. And it seems like in my time here, we've kind of been a hot balloon and just kind of blown anywhere the currents kind of took us, depending on what kind of came up to boil. I think that I'm just trying to find that constant flow of working as a board and knowing in advance, months in advance, what's going to come up. And I think the Hooker and Holcomb presentations, depending on how they fall in, obviously, Jared and others are going to want to have context and Board of Finance when it comes to discount rates and really trying to break those two meetings up. I think that's probably one of the most important things we do here is how we fund the liability. Just giving some context to it, and then if Caroline can send it out and get some feedback, and we can change it around, we can move it around however we want. But it's just kind of giving us all a little heads up and a game plan moving forward that I think would be good for the pension board.
All right. Thank you very much. You guys are chatty. Not so much chatty here, guys. Thank you. May I please ask for a motion to adjourn?
Motion to adjourn.
Tom McCarthy with the motion to adjourn. Second?
I'll second.
Okay. Chris Brand, thank you. Everyone, all in favor? Aye.
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 Have a great month, everyone. Take care.
Aye.
Carolyn, good meeting.
Brian, thanks.
Good night, everyone.
Thank you.